So where does the story begin? The story actually begins with financial liberalization. I would like try to skim through some of these basic preliminary slides, which I think most of us are familiar with in this audience. So we understand that most of the emerging markets have been moving towards financial liberalization. It has both a domestic component and an international component. Much of the literature does not make the distinction very explicit, but it's good to keep that in mind. And when we're talking about banking liberalization, it's a particular component of the internationalizing the financial sector, and one dimension of it is foreign bank entry, and that's where we place this in the larger context. And again, we're not dealing with cross-border flows here, we're just foreign bank entry associated with the right of establishment. I'll get back to it. If I have to summarize this the strand of literature on foreign bank entry and what it does in different dimensions, just this chart will hopefully help. I'm not going to go through each and every particular dimension, but broadly, if you want to summarize this, you understand that there are a lot of papers that talk about the impact of foreign banks on banking efficiency. There's an overwhelming research actually on how they drive down costs of financial intermediation and how they affect, enhance efficiency in the host economies that they present. Now, the another strand, now it's also upcoming, is on financial sector development. Now, of course, keeping aside all the econometric endogeneity issues apart, I think the literature tries to really tease out some of the issues about whether foreign banks could have a positive impact on financial inclusion and also they contribute to deepening of financial markets, bond market development or stock market development, etc. And another strand, of course, after the crisis, it became much more prominent, but is also important is that what they do to the macroeconomic and financial stability. And one of the two dimensions, again, if you break that down broadly, you can think about the crisis transmission from the international crisis transmission angle, and you also have the domestic side of things, the domestic, how do they respond to domestic monetary shocks, and what happens to monetary policy transmission domestically. So one channel of transmission is a traditional interest rate transmission that we are trying to deal with in this particular paper. Now, why interest rate transmission? Well, very simply, there's been a greater interest, a lot of interest in, a lot of interest in the country is moving towards flexible exchange rate regimes. We see the growing popularity of inflation targeting, and that obviously puts, puts interest rates as a principal tool of macroeconomic management. And so it's interesting and important to understand what's going on, especially in the emerging markets. Well, a lack of substitutes for bank-based financing, so it's an interesting dimension to look into, and also given that how foreign banks could affect financial sector development, in turn it has an implication on interest rate pass-through, it becomes important to understand these issues. Now, if we were to summarize again, to briefly run through what the conceptual framework is how do we understand interest rate pass-through? Very, very basic way of defining it. Well, there are two broad ways of decomposing interest rate transmission. One way to look at it is the cost of funds approach. Another one is your monetary policy approach. The cost of funds approach, again, tells us that it happens in two stages, right? In market-based economies, typically with well-developed financial and government bond markets, we find that the changes in the policy rate first are typically transmitted to the interbank rates, the money market rates, for instance, and then the second stage, we see the changes in interbank rates are passed on to the short end of the yield curve, and then to other yields of higher maturity, and then to the retail lending rates through the government bond market. So the key is arbitrage, and that's the beauty of a market-based economy when it's also functioning well, and there's competition and well-developed bond markets. You see all these things happen, and this is smooth transmission as such. Now, the sum and substance of what we are saying is essentially, can be summarized in this equation. The spread between the lending and the policy rate can be, broken down into three components. Starting from the right, we understand that it depends on the spread between the policy rate and the money market rate, and then the money market rate and the government bond rates, and then the government bond rate and the lending rate. So that's a intuitive breakdown of how interest rate transmission works in this way. Now, what happens in countries which do not have well-developed, sophisticated financial markets or government bond markets with limited banking sector competition? We do find interest rate transmission still occurs, but it occurs through moral suasion, and we have, typically it's also a characteristic feature of many countries where you have government dominant or private bank-led oligopolistic systems. It occurs through this model subversion channel. That's the way, that's the conceptual background. Now, where does foreign bank presence or entry, make the distinction between the two in a minute, but become important, and why should we care about what foreign banks do in general, right? One, we understand from a growing literature that foreign banks do strengthen the transmission channels through efficiency and the financial market development. It's an indirect channel, indirect way in which they strengthen. Like this powerful quote from the World Bank, the Global Financial Development Report, which I thought was useful, which summarizes how foreign banks have supported, the development of local financial markets. They act as primary dealers in some government bond markets and swap dealers in other markets. So there is a link that we have to recognize in the way they affect or they contribute to the efficiency of and financial market development. Now, it also enhances the banking sector competition, which you would expect to, which will ensure the operation of arbitrage in an economy. Now, the question we are trying to ask and what we are trying to hypothesize here is whether this relationship between foreign bank presence and interest rate pass-through necessarily linear, because given the variations that we see in the countries, when you take up emerging markets as a pool, you see different degrees of foreign bank entry on presence in different countries. So then, do they affect interest rate transmission in the same way in every country? Probably not. And is there a way to tease out those connections and see if there's an interesting story to be told out there? That's what we are trying. That's where we are heading with this paper. And in the process, we are trying to see if there are some thresholds that we can think about or we can identify, which will give you some idea and explanation as to what they do in some countries with different degrees of foreign banking presence. Now, as we know, we do see a lot of heterogeneity. Different countries opened up. Some of the countries, especially, there was a clear case of a financial crisis, say in Asian countries, for instance, in '97, that paved the way for greater impetus for foreign banks to come in, because they were brought in to recapitalize their beleaguered banking systems at some level. So there was sort of an exogenous shock that allowed these banks to come in at some point, especially for crisis point. And given that there are different degrees of banking presence in very different regions, we are trying to figure out how this affects the interest rate transmission as such. Now, I will come back to the data again. This is basically from the Claessens and Van Horen data, which is again integrated with the Global Financial Development database right now, which measures a share of foreign banking assets as a percentage of the total banking assets in a particular country. So what is a motivation hypothesis as such? I mean, we're trying to say that if there are high degree of foreign banking thresholds, then we understand from the literature that there is a possibility of that enhancing greater banking efficiency and financial sector development, which will lead to higher interest rate pass-through as such, right? That's through the indirect channel that we understand. Now, if you have low degree of presence, which could imply or may not necessarily, but then it could imply a greater degree of state ownership, then it could also again result in a high interest rate transmission, but that happens the direct way, that happens to the model subversion channel. Now, what about these countries which are in the process of liberalizing their banking sectors? They have intermediate stages, for instance, right? So we do presume, or we do hypothesize that there is a weak, it will result in a weak interest rate transmission because, well, there is on the one hand a gradual reduction in the model subversion power, which reduces the effectiveness of the way in which directly it affects the interest rate transmission. On the other hand, you don't have sufficient degree of competition in the form of foreign bank entry. You could still have private sector competition. That's a caveat. We are aware of that. But if you have insufficient foreign banking presence, then there is not sufficient financial sector development as such. And so the second stage interest rate pass-through may be weak as well. So that could, in a combination of the two, could result in a weak interest rate pass-through. So is there a credible basis to believe that there is a story to be told out here in terms of differing degrees of foreign bank presence and how they affect interest rate pass-through? That's what we are trying to get through. And as far as the literature is concerned, again, you have two strands. One, most of them have dealt with the bank lending channel, the supply side of things. They haven't really talked about interest rate pass-through in this context. But the ones that have, there is a very small literature, but a set of papers effectively look at the determinants of interest rate transmission, and they don't really explicitly factor in financial sector development or foreign bank entry in a very explicit way. There's the most closely related paper to us is the IMF working paper that came out in 2011, which talks about determinants, and we follow that. It's in that spirit of that particular paper, but we have a different set of hypotheses we're trying to test for and we're looking for. And what we are also interested as a sub-bullet point, we will get to it, is what happens when greater competition results in a concentrated market structure. So what happens, from here I think the results, we can jump to the results because there's only one methodology slide I have to talk about. So essentially we're interested in looking at how does foreign bank presence affect the interest rate pass-through, and are there threshold effects, right? So the caveat to keep in mind is we don't have good data on entry, so we have the flow idea, so we have data on stocks, so which is foreign bank presence. We don't cover cross-border lending, and we don't make the distinction between branches and subsidiaries because we're dealing with assets data. Now, standard fixed effects, country fixed effects, time fixed effects. What we are trying to do here, this is again following the literature, no innovations here in terms of the empirical strategy. What we're trying to do is to see if the interactive effect of foreign bank entry on money market rates, given that most countries use money market or interbank rates as the target rates for monetary policy, that is used as a proxy in policy rates in many papers. So we follow that. So we're trying to understand whether that has any meaningful impact, right? So we are looking for the significance of beta 3 specifically, and then beta 1 should give you IRPT, or the coefficient of interest rate pass-through. Foreign bank assets, I don't think I have time for this, I'll come back to this later. Standard control variables, thresholds, we are again arbitrarily specifying exogenous thresholds. But first, by explicitly trying to see if there is any meaning in adding a quadratic term, the first test, first cut, and then we see what happens. There is no basis for this explosive relationship, but we just want to see if there is any story to be told, and then from there we move on to splitting the sample. So all we do from here on is we split the samples into different thresholds in terms of asset sizes, because that's what we're interested in, and then we are testing to see if that has any impact or not on interest rate pass-through. And what do we find? I'll skip all this. So what do we find? We find in the full sample, we do see nothing going on. It's not very useful. And then we add on a quadratic term. We find something going on. We find something is interesting. And so it's intriguing. So we want to start by identifying, splitting the samples based on different thresholds. I'm sure there is a much more sophisticated way of doing this, and I'll take your help and comments on that. I would love that. But the point is, the starting point, we wanted to use this, and we started with the mean as such, and then we also use median and different time points as different thresholds, and that's how we define the high thresholds and the low thresholds. And then we run the same set of regressions to see the test for the relationships of interest, and we do find that it matters a lot in high threshold sample. The IRPT is complete. Increase in foreign bank presence is associated. Well, all this conforms to the priors broadly, but what is also interesting is when you control for banking concentration as well, it reduces the pass-through by approximately 13 percentage points. We don't know what's really going on there, but then that's something to think about and tease out better. And in low threshold sample, as we would expect, there is nothing going on in terms of foreign bank presence specifically, but the interest rate pass-through is still complete, and that again conforms to the priors because we believe that it does happen through the direct channel. So this is a summary table. You see the coefficients, and then if you add what is the interactive effect of foreign bank presence, and the dashes just mean that they are not worth reporting because they're insignificant, but we still do see high pass-through in low threshold and high thresholds. And I mean, in a high threshold samples, we do see incomplete pass-through, but foreign banks boost that. So we find that there is something going on here which needs to be teased out. And these are our robustness checks. We try moving around sample thresholds in different points. And very broadly, we do find support for that in a high threshold sample. Not so much in low thresholds. Admittedly, this is an arbitrary way of exogenously specifying thresholds, and there could be much more sophistication. That's a limitation of the paper, and we are trying to work on that. And also, we try to find something on concentration that's going on. So there could be a role for regulations to play to make sure that greater competition does not result in concentrated setup. Yeah, so we wanted to see if we could try two regimes, one without foreign bank entry, to make the identification strategy much more convincing. And also, if we could make the branch versus subsidiary distinction, it would be better. Thanks. All right.
So I just revised this paper several times, and I read this paper several times for several days. And I feel very interesting in these papers. And this paper has a lot of merits. I list a few. For example, that this paper is the first paper studied or focused as foreign bank presence, the effects of foreign bank presence on the interest rate pass-through in the monetary policy. And this paper also add to the existing literatures in the two aspects. First is the literature on the impact of foreign banks on the monetary policy. And the second aspect is determinants of the interest rate pass-through in the monetary policies. And I think that the author do a lot of tests and empirical tests, and I think this paper is a high-quality empirical papers, and also use a lot of large samples and the long period of observations. And I believe that this paper will arise strong interest in not only the scholars but also some policy makers. And when I read these papers, I encountered some questions. Maybe I think that a lot of most of the readers also meet this kind of questions. So question 1. So authors use the 57 emerging and developing countries in the samples. But I want to know that what is the selection crisis for authors? Why use the 57? Why not use the 60 or 70 more the samples? And also, I also very curious about why in these samples not include China, because I find that the authors select India, Brazil, Russia, and South Africa, 4 of the BRICS, but omit the China. Maybe I know also maybe some reasons why not choose it. So I think that you can give some explanations or reasons why you not choose these samples. Second, question 2. In the period of 1995 to 2009, just authors select this period as empirical period of observations. So I wonder that in this period, the government set some lower limit or the up limit on the lending rate. Because for some emerging and developing countries, the central government maybe have the strong financial controls on the interest rates, right? So if the central banks set some limits on the lending rate, maybe the interest rate pass-through will be incomplete, right? So maybe that the author should give some the information in this paper. And also, the question 3, I think that the GDP growth is has a close relationship with inflation rate, right? So I don't know that in the empirical test of the authors, these two variables has a low or high relationship. I don't know because the paper not mention it. So question 4, the author find that there are the threshold effect in the impact of the foreign bank presence on the interest rate pass-through. But I know that in the literature there are some existing techniques to invest or find the threshold effects, such as that there is a very common threshold regression models put forward by the Hansen, and also some quantile regression models. Yeah. So maybe I don't know why the authors not choose this regression models. Give some suggestions. Suggestion 1. In the section 2 of this paper, the authors describes use a half-row paper to describe the credit lending channels. But I think that the topic is focused on the interest rate pass-through or interest rate channels. So I think this content is not closely related to the topic of the paper. So it seems to be redundant. Suggestion 2. The author gives the explanations why they didn't choose the bank-specific variables, and the author gives the reason that because these data are not inconsistent. But I think that the true reason is because the authors use the country-level data rather than the bank-level data. So maybe that you could not find, because I checked your data set, and this data set didn't provide some bank-specific data, bank-specific variables data. So maybe I think the true reason is this, because your approach, empirical approach, is focused on the country-level data, not the bank-level data. Suggestion 3, in the robust check for the threshold, and the government, the authors find a very interesting conclusion, because that there is a weak impact of the foreign bank presence on the strength of the interest rate pass-throughs in the subsample of the foreign bank assets, the ratio of foreign bank assets larger than the 65%. I think that many readers are very interested in why you find this. Why is the reasons underlying these findings? Maybe I think that if the authors can provide the explanations, maybe it's better. And also, suggestions 4, the authors cite 2 important and popular papers. One is Blank and Blinder, and the second is Blank and Genders. But the authors cite these 2 working papers. But I find that these 2 working papers all has been published. So maybe for the government, it's better to cite the published paper rather than the working papers, because published papers has been under the reviewer and more formal, I think. And the suggestion 5, and just as the author mentioned that in the conclusion part, I not find that the author gives some further studies, but in today's presentation they give it. So I think that in the conclusion part, the author maybe add some further study in this field. And also, when I read these papers, I think that maybe there are some larger space for the studies. For example, I list 4 points. First, because the author used the country-level data, not the bank-level data. So, in the future, the study can focus in the future, the study can use the bank-level data. So, if you use the bank-level data, maybe they can use the bank-specific variables as control variables. So maybe that the conclusion is more interesting. This is first. Second, I think that there is a time lag in the interest pass-throughs, because now that if today's market, the money market rate change, but they need time to effect the lending rate. So if we consider this time lag, maybe in the future study, maybe we will get the more meaningful conclusions. And number 3, I think that in a lot of the emerging and developing countries, there is interest rate derivative markets, because this market, if the bank can use the interest rate derivatives, they can hedge the interest rate risk. So maybe interest rate derivative markets will, in fact, if this is a country has an interest rate derivative market, maybe it will affect the general interest rate pass-throughs. Yeah. And so fourth, I think that maybe the money market may not impact the lending rate directly, rather indirectly. I think that maybe the money market change then, in fact, impact the deposit rate. Then the deposit rate change and affect the lending rate. So maybe there is not the direct pass-through, maybe the indirect pass-through. So if in the future that the author or other researchers can study that whether the money market change will impact in the deposit rate, then the change of deposit rate impacts the lending rate. These comments are only for the author's reference only. Thank you. Thank you.